All right, for more on today's global market sell-off and what sparked it all, I'm joined by Joe Brusuelas. He's the chief economist at consulting firm McGladrey. Joe, good to see you. Thanks for joining us.
Thank you for having me on.
Joe, as we've just discussed, major carnage on Wall Street, the Dow concluding its worst week since 2011. And around the world, major indices also fell for the week, and most are now negative for the month. Joe, quite simply, why are we seeing this global sell-off?
Well, what you're seeing is a reaction to the secular slowdown in overall Chinese growth and concerns about a much more pronounced slowdown in overall global economic growth. You know, the U.S. economy is doing fairly well, but it's widely understood, at least in financial circles in the United States, that China is the other economic pillar in the global economy. So, if China does not pull out of this global economic slowdown, there is a concern that there could be a spillover effect, in particular into Europe, and then spill over in the United States also.
Well, as you say, Joe, you know, in this globally interlinked economy, China sneezes and the world catches a cold. It is a huge pillar of the global economy. We got data on Friday that manufacturing activity hit a 6-year low in July. There was also weaker than expected export data coming out in July. And, of course, this month's devaluation of the yuan and the continuing stock market plunge. Any hope in sight? What's going to take for things to sort of stabilize on the Chinese front?
Okay, so I think the first thing is that the Chinese fiscal and monetary authorities are going to have to get much more aggressive. Simply allowing the Chinese yuan to adjust another 3% downward over the next year is likely not to be sufficient. They're going to have to get much more aggressive, especially on the monetary side and the fiscal side. I'd like to see a rural electrification program in China. I think that would really bolster economic prospects in China and put a leg under global markets. Now, here's the important part. We don't want to make too much of this. Developing economies have become much more important over the past 20 years. When you think about real final demand, right? My sense is it adds about 5% to the big developing economies, which is double than where it was in '95. But it's not a decisive factor. I think what we have here is a combination of an overreaction to what's happening in China, very thin markets in the West as we're in the traditional vacation season, and some concern that the United States Federal Reserve may get very aggressive on their interest rate hikes. Now, the Federal Reserve hikes 25 basis points. I don't think that's really going to be a cause for further unwinding in global financial markets.
Joe, before we get to the Fed, let's focus a little bit more on China.
Sure.
You said that it's an overreaction.
Yeah. I mean, look, Chinese financial markets, there's clearly a bubble in the Chinese equity market. The Chinese Fiscal Authority clearly stoked that bubble to increase revenues into the local prefects. It worked until it didn't. But there's a difference between Chinese financial markets and the real economy. We have yet to see a spillover into the real economy, and that, I think, is the crucial point here. Will continue unwinding in Chinese equity markets cause a much more pronounced slowdown? That has yet to be determined, and I think that's why this is the cause of a little bit of an overreaction.
Well, do you think that the idea of a soft landing is still happening? It seems pretty soft to me. We expected this adjustment. We expected a reduction in the rate of growth.
Well, fiscal and monetary authorities are always going to talk about a soft landing. I think probably the better way to think about it is this, is that China is undergoing a structural transformation away from an emerging market to more of a mature market. There are clear problems in the residential and commercial real estate sectors, and the Chinese are trying to make this transition away from an export-oriented model towards a more inward-oriented model based around consumer spending. These sorts of transitions rarely occur with a soft landing.
Well, this is...
My point is that they're slowing. It's a secular slowdown. Over the last 30 years, you've seen a 10% rate of growth. You're likely probably more to see a 3 to 5% rate of growth. Financial markets are going to have to adjust to the new period of growth in China. You know, you've got a $10 trillion economy. If you're growing at 3 or 4%, that's fundamentally a good thing.
That is still definitely the envy of most developed markets. Very quickly, I want to ask you how this all impacts the Fed. That's causing a lot of uncertainty in the markets here, whether the Fed will raise rates in September. How does the China devaluation of its currency and the slowdown impact the Fed's moves?
Okay, my sense is that global financial markets find a bottom sometime by the middle of the next week, and the Fed moves ahead and hikes rates by 25 basis points, but that's probably it for the remainder of the year. And I think at this point, once we get some much better data, and we're going to see much better data out of the United States, financial markets will settle down, especially as we move into the fall and the thin trading season ends, both in Europe and the United States.
All right, we're going to have to leave it there. Thank you so much. Have a good Friday. Joe Brusuelas, Chief Economist at McGladrey.